First of all, Sam, congratulations on very strong numbers, 30% up on the earnings. Question is whether that can be sustained going forward.
Good to be here, Haslinda. The momentum that we reported today for 2017 is really a continuation quarter by quarter in 2017. In that respect, therefore, we do expect the momentum to continue into 2018.
What opportunities do you see given that Singapore is in a pretty strong position economically today? It said that 2017 it grew about 3.6%, and Asia as a whole is also gaining momentum. How do you hope to capitalize on the growth we're seeing across the region?
Well, first of all, I think the fundamentals of the key economies of which OCBC is in is actually very strong. Secondly, the investment sentiment, the consumer confidence has also significantly improved. So as a result of that, we believe that OCBC, having a regional presence in all the key economies in Asia, will be able to capitalize on all those opportunities as they come along.
But where in particular would that be wealth management? That is a key sector for you.
Well, this would include a number of areas. On the banking side, trade we do expect to pick up, particularly intra-Asia trade is going to pick up. General SME investments, which has been quite subdued over the past few years, is likely to increase as well. And you will notice that the property market has also been more activity in the property market. So this is on the banking side. Then we talk about the wealth management side. The wealth management business has been propelling the growth of all the banks, including OCBC, quite well in 2017. And this is a result of not only we are able to capitalize those opportunities, but also because wealth accumulation is really quite high. And there is a demand for private banking services, for wealth management services. So we are also capitalizing on that. Our insurance business, which is the third pillar that OCBC Group uniquely has, is also doing well because the fundamental need for insurance is also improving.
Sam, I want to ask you about your loan portfolio because you did single out oil and gas services there as obviously the weaker part. You have provisioned a little bit more to address that or to reflect that weakness in your portfolio. Do you think the bulk of the provisions is now behind us? And equally, I guess, do you think that part of your portfolio can worsen in the months ahead?
The risk in the oil and gas portfolio, I can describe, is now comfortably contained. We have created additional provisions against it. On the other hand, we're actually seeing some charter inquiries which are stronger than before. And there is also major oil companies starting to look at projects in deep sea drilling. All these are favorable towards the oil and gas portfolio. Having said that, however, the charter rates, despite the rise in oil prices, have not been strengthening, and the visibility as to when are they going to strengthen is a bit uncertain. So as a result of that, despite the fact that there are indicators that saying that the worst is behind us, we decided just to contain the risk by creating the provision against it. So can we move forward with a stronger balance sheet and without that particular sector to continue to drag the bank's earnings. But we are still working with the borrowers in this particular segment to help them to work out of the current depressed state.
And I know it's very hard to extrapolate into the next quarter because a lot of moving parts, as you mentioned here, but do you actually see yourself provisioning more than you did last quarter into this specific part of your portfolio?
I think this portfolio is currently quite sufficiently provided for.
Sam, touching on wealth management again, you made a couple of acquisitions. Is there a need to look at more acquisitions going forward?
It's a focused area for OCBC Group, and we have been doing very well. We have built up a good reputation in wealth management side under the Bank of Singapore brand and also under the OCBC Group where we do premier and premier private banking sector. It's a business that we would like to continue to scale up. You know, this is not a cheap business to be in. The cost that you need to invest into the private banking and wealth management side is quite significant, not only in terms of regulatory compliance costs, but also in terms of technology platform, product platform, and the suite of services that we need to extend. So in order to scale up and amortize the cost over a larger base, we will continue to organically grow this. In addition to that, should there be opportunities in the market that is appealing to us in terms of culture, in terms of the customer sector, we would be interested to look at that. But we always say that because when market opportunities present themselves, we will always look at those.
In order to scale up, as you put it, do you see the need to hire more portfolio managers?
It is still on a growth mode. As a result of the recent acquisition of Barclays, we've added quite a bit of RMs and very qualified, knowledgeable RMs into our base. With the recent acquisition of NAB, National Australia Bank's portfolio on the wealth management side, it was included in the personal banking side, but we have also recruited some very highly qualified relationship managers there. So in terms of people, we would like to continue to invest in them and continue to look for additional recruitment.
Sam, just back on your results here. So we're looking at a second half dividend here of essentially 0.19 Sing dollars a share. Now, your rivals DBS and UOB handed out a special dividend to their investors. I know it is a prerogative, obviously, of the bank and its board to determine that, but just help us understand, and I'm sure a lot of your investors are wondering why they did not get a special dividend this time around.
Okay. Good question, particularly against what we're seeing the other two banks are doing. But I think we should put it into the context that our philosophy has always been to deliver a sustainable and reliable dividend stream to our shareholders. We have publicly declared that we would like to declare 40 to 50% of our core earnings as dividend to the shareholders. So the shareholders can expect what is likely that they will be able to get. Second consideration factor is that we would like to have enough capital to continue to look for growth opportunities organically as well as inorganically. So these are the opportunities that we think having a stronger capital base, retained more of our earnings within the bank is the right thing to do. On the other hand, also look at the return on equity. Our return on equity has improved from last year's 10% to this year's 11.2%. So from a shareholder's return perspective, in terms of return on equity, I think it is quite appealing, and we would like to continue to make use of the capital to deploy in areas which are attractive to our shareholders in the long term.
Sam, just to pivot here to the macro environment and what the bank is, I guess, in a lot of ways feeling right now. We've seen money market rates start to move up, which I imagine would be symptomatic of tighter financial conditions. Are you starting to feel that in OCBC in the interbank market?
Yes, we do see that. The SIBOR rate has also gradually moved up. It is not at the same magnitude as the US dollar rates have moved, but I think it will follow the global trend and follow the US dollar trend of moving up, which therefore is also beneficial to the banking operation because, as you know, we have about 50% of our deposits in current account and savings account, which tend to be lower yielding, and we'll be able to get a better return out of that.
Sam, just one final question. Your take on the rout we saw last week, a correction in a bull market, you think?
I think if we look at the fundamentals, there has not been any significant change in opinion that the fundamentals of the key economies continues to be quite strong. In that respect, therefore, I think the financial market sometimes could have gone ahead of the fundamentals, and as a result of that, there is some efforts to liquidate it and then restart. So I would not pay too much attention to what the financial market is evidencing, but try to look at the fundamentals. And I think the fundamental continues to be quite strong.